Good evening and welcome to Market Pulse Weekly, where we make sense of the chaos in the business world because someone has to, right? Whether you're trying to strike gold with your next investment or just hoping your retirement plan survives the week, we've got you covered. Tonight we will break down the numbers, crunch the data, and who knows, maybe even predict the next market meltdown because in today's economy, the only thing more unpredictable than your portfolio is your boss's mood on a Monday. So sit back, relax, and let's talk money, because if you're not laughing about it, you're probably crying. In a stunning twist of events, the EU has finally decided to follow in the footsteps of the US and UK, agreeing to speed up trade settlements. Yes, folks, the old European Union is finally trying to fast-track things, moving from T+2 to T+1 settlement times. Now, instead of waiting a whole 2 days in settlement transactions, they will get it done in just 1 day. Revolutionary, right? But wait, it requires more Brussels legislation because what's progress without a bit more red tape? Oh, Europe, you always know how to make even the simplest things complicated, while financial market actors are celebrating. I'm over here wondering how many more years this fast tracking is actually going to take. After all, if it's not slow and bureaucratic, is it even Europe? International financial markets are buzzing about the EU's latest potential move to settle transactions faster, finalizing them 1 day after trades are made, known as T+1. But of course, there is a catch. This will likely require new legislation from Brussels. To move quickly would involve paperwork. That's right, the EU regulators are essentially saying, hey, if the US and UK can do it, why can't we? The financial sector is already popping champagne, hoping this shift might also help smooth things over the UK post-Brexit. Because what better way to patch up a broken relationship than faster paperwork, right? Apparently, T+1 settlement brings important benefits like reducing risk, cutting costs, and saving margins. The European Commission, European Central Bank, and ASML are all in agreement. The EU better speed things up if they don't want to fall even further behind. Well, they say it's urgent, but let's be real, this is Europe. Urgency usually means see you in a couple of years.
So long, losers!
As interest rates continue to drop, European stocks in sectors like financial, consumer discretionary, and industrial are riding high, with borrowing costs plummeting and consumer spending on the rise. These sectors are apparently having their moment in the sun. But let's not pop the champagne just yet. We have all seen how quickly those market gains can vanish when a recession decides to make a cameo. That's right. Rate cuts are always a party until they are not. The European Central Bank's latest 0.25% reduction has investors scrambling to figure out where to park their money next. Goldman Sachs analyst Peter Oppenheimer says we are entering a benign part of the cycle. Benign? I would say we are more like in the eye of the storm. Calm for now, but don't let your guard down, folks. So here is the top 10 performing European stocks from last month. Go ahead and take a screenshot, but only if you've got the cash to spare and the cigar to celebrate, or maybe to stress smoke when things go south. In other news, Morgan Stanley shares jumped 7% after beating expectation for third quarter profit. But before we break out the confetti, let's not forget, didn't Lehman Brothers also flaunt their profits right before they crashed and took the global economy with them? Maybe we should take a closer look at those numbers before we start high-fiving the C-suits. Exactly. Morgan Stanley reported earnings of $1.88 per share, beating estimate of $1.58 with revenue hitting $15.38 billion, also higher than the forecast. The firm's profit rose 32% thanks to buoyant market and rebound in investment banking. Sounds like a win, but hey, we've seen this show before. CEO Ted Pick called a strong third quarter in a constructive environment. Sure, sounds great. If by constructive he means the Federal Reserve lowering rates so investment bankers can get back to what they do the best, making deals and cashing in. Share rose 7.5% in early trading because Wall Street never met a rate cut it didn't like. Revenue from their wealth management division jumped 14%, investment banking surged 56%, and trading activity was up across the board. Everything's looking at Morgan Stanley. But remember, folks, when Wall Street starts cheering this loudly, it might be the time to check if there is another iceberg ahead. Stay tuned for updates as this story develops or unravels. Airbus also making headlines this week. The European aerospace giant is cutting up to 2,500 jobs from its defense and space unit. They blame disrupted supply chain, rapid changes in warfare, and budget constraints. Funny how they never mention spending cuts when they post record profits though, right? Well, if laying off thousands of workers is part of their strategy to become leaner and competitive, I would hate to see what their idea of expansion looks like. But hey, at least the world's chaos is keeping the defense industry employed.
It's not Lord of War, it's Warlord.
Next up, ASML shares just took a nosedive, plunging a shocking 15.7%, their worst drop since going public in 2002. And why? Well, someone accidentally hit the send button a little too early on their earnings report. Yes, that's right. A premature release of their third quarter earnings forecast sent investors into panic. Oh, ASML, you are in the business of nano accuracy, but apparently email timing is still a bit of a challenge. Seems like the semiconductor industry isn't just about chips, it's also about chipper timing blunders. And let's not forget the semiconductor drama. ASML seems to have spread, with chip maker stocks like Nvidia and ARMS also taking a hit. Yep, I guess US sanctions are clearly doing their job, except on China, who's still happily churning out chips while the rest of the industry burns cash. Well done, everyone. Maybe next time we will think twice about trying to outsmart the global supply chain. What's the point of punishing another country if you end up punishing yourself? In brighter news, Taiwan semiconductor manufacturing company TSMC posted a 54% surge in third quarter profits. AI demand is driving their growth, and they are expecting a 35% year-over-year revenue increase by the end of this year. Don't you just love it when AI saves the day? TSMC is riding high, while ASML trips over itself and US policymakers think they are pulling the strings. Seems like American lawmakers are really good at controlling companies, as long as those companies are not their own. Google's complaint claims that Microsoft's cloud licensing system is so restrictive. IT departments are practically handcuffed to their product. But don't worry, Google just wants to level the playing field, so everyone else can have a fair shot at being a monopoly too. And let's not forget Microsoft's already under scrutiny for its Teams product, facing another EU antitrust probe. If found guilty, they could be fined up to 10% of their annual revenue. But hey, maybe they will amicably settle it. Just like before, corporate drama at its finest. Over to the tech world. The irony, Google is now throwing a tantrum because Microsoft is allegedly playing dirty in the cloud market. Yes, Google, the epitome of competitive fairness, has filed an antitrust complaint with the European Commission. Apparently, Google's not too thrilled that it's no longer the only monopoly in town. Tragic, really. Speaking companies who seems to care. Revolut is not holding back in its critique of Meta. The fintech giant says Meta's effort to tackle fraud on Facebook and WhatsApp are about as useful as, well, a screen door on a submarine. Revolut suggests that Meta should not only monitor fake ads but also reimburse the victims because they've already sold our data and gotten away with it. So what's little compensation now, right? But let's be real. Do we really expect Meta to care? They have got bigger fish to fry, like making money off our personal info. Meta's defense, they are rolling out an information sharing program with UK banks to tackle scams because sharing is caring, right? Unless, of course, we are talking about profits from fake ads. Those they will keep. According to Revolut's figures, purchase scams are still the top source of fraud across Europe, the UK, and beyond. But hey, why bother fixing the problem when you can just profit from it instead? Market Pulse Weekly. Stay tuned for updates. Market Pulse Weekly. Stay tuned for updates.